to Market Doc. Today we're going deep into, how markets reacted to news during COVID-19.
Oh, yeah, a really wild time.
Definitely. We've got this research paper by Harry Mamaysky from Columbia Business School. It really digs into how the news cycle kind of swayed markets during those first few months of 2020.
Yeah, it's interesting because they actually looked at almost 190,000 Reuters articles from 2020
Wow.
to see how they impacted things like the S&P 500, the VIX high-yield bonds, even U.S. Treasury yields.
So it's not just like a general news affects markets thing. They actually got kind of granular with it.
Yeah, they did.
So I'm curious, how did they measure like the narrativity of the news? Like, how do you tell if a news story feels more like a drama versus like a dry financial report?
Right. So they had this really clever approach. I compared the COVID-19 articles to two totally different types of text. One was stories about the 1987 stock market crash, inherently dramatic.
Oh, yeah.
And then Federal Reserve statements, which are generally pretty factual and low-key.
Right.
By comparing the language, they could figure out how much each COVID article was like telling a story.
So if a COVID article used really similar language to those 1987 crash stories, that would be considered high narrativity.
Exactly.
Okay.
And what they found was that those high narrativity pieces were actually more likely to cause these immediate market reactions.
Wow.
It makes sense if you think about it. We respond to stories as humans, and that doesn't just disappear when we're talking about finance.
Right. It's like our natural instinct is to react to a good story, even if it's about like interest rates.
Absolutely. It can make us react without even realizing it.
So then it's almost like the facts themselves aren't the main driver. It's the way those facts are presented that really gets us going.
They actually connect this back to something called the availability heuristic.
Okay.
Which is a cognitive bias where we overestimate the likelihood of things that are easy for us to recall.
Right.
So, dramatic news, it just sticks in our minds.
Yeah.
So it makes us more likely to overreact, even if a calmer analysis might tell us otherwise.
It's like that old saying, don't check your portfolio after watching the evening news.
Exactly.
Right. But this study didn't just stop there. They also looked at how sensitive the markets were to this news, especially during volatile periods.
Right. They found something they called hypersensitivity, which is basically when volatility was high, as measured by the VIX, the markets became even more reactive to news.
So it's like if the VIX is spiking, and then there's even a small change in the news, it could trigger a huge market response.
Exactly. Wow.
It's like adding fuel to the fire.
And I can only imagine how high that hypersensitivity was in those early days of the pandemic. Everything felt so uncertain.
Oh, absolutely. And the study actually pinpointed this big shift in mid-March 2020.
Okay.
Right around when the Federal Reserve started intervening and the CARE Act came in.
Right.
So before that point, news and markets were super tightly synced. After that break, the connection weakened considerably.
Which makes sense if you think about it, right? The Fed stepping in and those stimulus efforts were all about trying to calm the waters. Yeah.
Did the study talk about how those interventions actually impacted those market dynamics?
Yeah, so they were focused on injecting liquidity calming fears and impacting discount rates. It was like saying, hey, everybody relax, it's going to be okay. But what's really cool is that this break wasn't just something they saw looking back. The data from the end of April 2020 already showed this shift happening.
Wow, so they could see the markets kind of detaching from the news cycle in real time?
Exactly.
That's fascinating. It makes you think, maybe we could use this type of analysis to like navigate future economic problems. But before we move on, you mentioned earlier that most of those asset price movements were driven by changes in discount rates, not really cash flow expectations. Can you explain what that means for our listeners?
Sure. So think of it like this. A company's future cash flows are like its potential to earn money, right?
Right.
But those future profits are only worth something today if you consider the risk and uncertainty of actually getting them. And that's where the discount rate comes in.
Got it. So a higher discount rate basically means those future profits are worth less today because people are worried about the future.
Exactly. And in those early days of the pandemic, fear was high, which pushed discount rates way up. So we saw these big price drops, even when a company's core business hadn't really changed all that much.
So it's almost like that narrative of doom, driven by all those high narrativity news stories we talked about. That was actually impacting the discount rate itself.
Yes.
More so than any actual changes in those companies themselves.
That's a really good point. And the research supports that. They looked at ETF data and found that most of the price movement was driven by changes in those discount rates, not cash flow expectations.
Which makes total sense if you consider the Fed's actions in the CARES Act, right? They were all about calming those fears. Lowering discount rates would have helped to stabilize the markets and prevent a total meltdown. So we've got this powerful connection between the high narrativity news and those big market reactions, especially during times of volatility. And then we see this shift in mid-March when the Fed steps in. But did they look at different types of news? Was it the same for every topic?
They absolutely did. They didn't just lump all the COVID-19 news together. They broke it down into 12 different topics.
Wow.
Using a machine learning technique called latent dirichlet allocation, or LDA.
LDA.
Yeah.
That sounds complicated. Can you break that down for us?
It's basically a way to automatically identify themes in a large collection of text. Think of it like sorting your emails into folders, like work, personal, spam.
Right.
LDA does something similar with the news articles, grouping them based on their keywords and their content.
Okay, so they divided all those COVID news articles into more specific categories like healthcare, economic, impact, travel restrictions, that kind of thing.
Exactly. And they ended up with 12 distinct topics. Some of them were more factual, like news about central banks or currencies. Others were more narrative-driven, focusing on things like how the markets were reacting or the impact on corporations. And they analyzed how each of those topics, with their different levels of narrativity, influenced market movements.
This is where it gets really interesting. Which topics caused the biggest market ripples? Especially during that pre-break period when everything was so sensitive.
So remember how we talked about measuring narrativity?
Yeah, comparing those COVID articles to the 1987 crash stories and the Fed statements.
Exactly. The closer an article was to those crash stories, the higher the narrativity score.
Got it.
And they found this really clear pattern. The topics that use language similar to that 1987 crash narrative, things like markets, Europe, and corporate earnings, those had the biggest impact.
It's almost intuitive, right? Headlines about like markets crashing or companies struggling, those would naturally trigger that emotional response.
Exactly. And it wasn't just about the direction of the market move, but also the size. These narrative-heavy topics were more likely to cause big swings, both up and down.
So a story about European markets tanking could actually cause a bigger drop in the S&P 500 than like a factual report on the Fed's latest move.
Yeah.
Even if the Fed report was objectively more important.
It seems that way, especially during that period of high sensitivity. It really highlights the power of storytelling, even in finance, which is supposed to be so rational.
Right. But it wasn't all one way, right? You mentioned earlier how the news was also influenced by past market movements.
Yeah, like a feedback loop.
Yeah, so a huge sell-off on Monday would lead to a Tuesday full of headlines about why the market crashed. Just trying to connect the dots for our listeners.
Exactly. And the more dramatic the market move, the more dramatic the news coverage. Which makes sense. News outlets are always trying to explain what's happening in the markets, and big swings get people's attention.
For sure, but did they only look at what the news was covering, or did they also consider, like, the tone of the coverage?
That's a great question, and yes, they did. They found that the tone of the news was also really influenced by those past market movements.
Can you give us an example?
Sure. Let's say the S&P 500 had a really strong positive day.
Okay.
The next day's news was more likely to be positive as well, talking about things like economic recovery and strong earnings.
So it wasn't just reporting on the market move, it was actually mirroring the market's emotional state.
Exactly, and this was especially true for those high narrativity topics.
It's almost like the market and the media were feeding off each other.
Yeah.
Creating this amplified cycle of boom and bust. It makes you wonder how much of this is just natural, and how much is driven by the incentives of the news cycle. You know, the need to grab attention.
That's a great question, and it's one the researchers don't really answer directly, but they do stress how important it is to be aware of these dynamics.
Right, because if you're not careful, you could get swept up in the emotional waves and make decisions that aren't really in your best interests.
Exactly, but understanding how narrativity and hypersensitivity work, that gives you a chance to filter out the noise and focus on the fundamentals.
Which brings us back to that critical thinking piece.
Exactly. Don't just react to the headlines, especially those using strong narratives or emotional language. Take your time, understand the information, look at multiple sources, and be wary of anything that feels overly simplistic or driven by emotion.
Great advice, but we've been talking a lot about what happened before that mid-March break when things were really volatile. What happened once the Fed intervened and that connection between news and markets weakened? Did the power of narrative fade away?
Yeah, that's the big question. And the short answer is, yeah, narrativity did lose some of its power after that break.
So those dramatic headlines about markets crashing or companies taking off, they didn't have the same impact anymore.
Exactly. The relationship between news and markets weakened across the board. Basically, the market just wasn't as sensitive to the daily news anymore, no matter how exciting the story was.
We talked about how the Fed's actions probably played a role in calming things down. But did the researchers find any other shifts happening around that same time?
They did. Remember those 12 different news topics?
Right. Some were factual, like central bank stuff, and others focused on those market narratives.
Well, after that break, it was actually those more factual, less narrative-heavy topics that seemed to have a bigger influence on market moves. It was like investors shifted from reacting to stories to actually analyzing information.
Makes sense. Once the initial panic died down and the Fed stepped in, investors probably had more breathing room to think rationally.
Exactly. And this shift showed up not only in how the market reacted to news, but also in how the news itself was influenced by past market movements.
I mean, that feedback loop we talked about earlier, where a big market swing one day would lead to a bunch of emotional news stories the next?
Exactly. After the break, that feedback loop weakened a lot. The news was still covering market events, but it wasn't just mirroring the market's mood anymore.
So less hype, more focus on the actual data and what policymakers were doing?
Yeah, it seems that way. Both the market and the news cycle got less reactive, more focused on the fundamentals. And this has some pretty important implications for investors.
I'm listening. What does it mean for someone trying to navigate the markets, especially during those crazy times?
It really highlights how important critical thinking is. Don't get swept away by headlines, especially those that use strong narratives or emotional language. Take the time to understand the information, look at different sources, and watch out for anything that feels too simple or driven by emotions.
Solid advice for any investor, but especially important when things are volatile and our brains are wired to react emotionally.
Exactly, and even though narrativity lost some of its influence after that break, it's still something to watch out for. It can always sway our judgment if we're not careful.
So stay informed, stay critical, and don't let the narrative take over your decision-making. Those are the key takeaways for navigating these markets. As always, this was a fascinating discussion. Thanks for joining us for this deep dive. Until next time, keep learning, keep questioning, and stay informed.